Friends, something big is happening with regards to the American economy right now, and I don't think many realize it yet. And that is, 5 decades of Keynesian economic policy is being repudiated as we speak. Now, I know that might not sound like much on the surface, but stay with me here because this may be the most important development for anybody who's concerned with personal finance and investing. For more than half a century now, the people running the most powerful financial institution in the world have all shared the same basic worldview. In their view, they saw the economy as a machine that needed to be managed from the top down. As such, they believed that useless government spending could stimulate the economy, and they believed that inflation was something that just kind of happens, like the weather. And they believed that when inflation gets bad, the only cure is to deliberately slam on the brakes to curtail economic growth. That was the Keynesian orthodoxy. It was the consensus for over 50 years. But Kevin Warsh, the new Federal Reserve chairman, spent his first few weeks on the job making it clear that those days are over. Ahead of his confirmation, Warsh promised regime change at the Fed. Many of us thought he was just referring to cutting rates aggressively because that's what President Trump has said he wanted. And Warsh, of course, is Trump's appointee. After assessing the actions he's already taken and then doing some research on the man's background, I think we may have underestimated Mr. Warsh. When he said regime change, it appears that he meant it. Today, we're going to unpack what that means, both for the American economy and for our approach to personal finance and investing. So let's get into it. Hello and welcome back to the Phoenician League podcast. I'm your host, Joe Withrow. If you were with me last week, you may remember that I made a pretty bold claim. I said that the days of Keynesian economic policy in America are over. And I suggested that globalization and financialization are both being reversed right before our eyes. But the financial media is not going to report it that way because their entire business is built on the old system. So last week, the evidence I pointed to was on the fiscal side. It was Treasury Secretary Scott Bessent standing up at the Economic Club of New York and making it clear that they are seeking to implement Alexander Hamilton's American system, or at least a modern version of it. Well, this week, we got a second piece of evidence. And this one comes from arguably the most important institution in the entire country, which is the Federal Reserve, the Fed. Before we dive in, I have to admit to you that my running assumption was that President Trump would only appoint a Fed chairman that was largely willing to do his bidding. You know, someone who would cut interest rates on command whenever the president wanted cheaper money. That's what I expected, and as did many other analysts. Guys, Kevin Warsh does not appear to fit that mold at all. I mean, we'll see how it plays out, but based on what I've seen and learned of the man thus far, I'm confident in the assessment that I'm going to share with you today. Now, Warsh served on the Fed's Board of Governors previously, and I should put served in quotation marks here because I'm not sure that's the proper description. But he's been inside the organization before, and he was known for having a hawkish stance on monetary policy. And what that means in plain English is that he did not favor the regime of artificially suppressed interest rates that we've lived under for most of the last 2 decades now. So he never liked the idea of the Fed holding rates down near zero year after year to flood the system with cheap money. What's more, Warsh was there in 2008 when Ben Bernanke took the Fed way off the rails. And then Warsh later resigned in disgust. He seemed to have put his money where his mouth was, so to speak. So now Warsh just had his first Federal Open Market Committee meeting, or FOMC meeting. And that's the meeting where the Fed sets interest rate policy. I think now we finally have some real clues about what regime change actually means to this man. So let's walk through it together. Because when you see the moves he made, and then when you understand where this man comes from, I think you'll see the same picture that I'm seeing. Okay, so in my assessment of it, Warsh announced 3 key moves at his first meeting, and they kind of go hand in hand. The first move, Warsh removed forward guidance from the Fed's public statements entirely. For those of you who don't follow kind of the plumbing of central banking, and I don't think there's any reason most people should, forward guidance is the practice of the Fed telling the markets in advance what it intends to do next. This became a standard tool over the past 20 years or so. And the idea was that if, the Fed signals its intentions on monetary policy, if it can do that clearly ahead of time, then the markets won't be surprised by any moves and volatility will kind of be muted. So Warsh put a stop to that game. He said forward guidance was not well suited to the current policy conjuncture. He also said that investors shouldn't rely on Fed prophecy. I have to chuckle a little bit there because this guy does not appear to be a man who minces words. So Warsh made it clear that the Fed, it's not going to tell anyone what it plans to do next anymore. There will be no more insider games based on getting advanced access to that information either. Okay, so the second move pertains to what's called the dot plot. And it strikes me as rather childish, but the dot plot is a chart where each Fed official marks down where they think interest rates are going to be in the future. So every Fed official involved places their own dot on the chart, and that signals whether they think interest rates are going to go up or down. And based on the most recent dot plot, 9 of the 18 officials now project a rate hike later this year. So that's a Fed that's quietly turned hawkish, right? Leaning towards raising interest rates, not cutting them. But here's the interesting part. Warsh himself, he declined to submit a projection at all. He didn't place his dot on the chart. And when he was asked about that, his answer, I think, to me was fascinating. He said he didn't think it was appropriate to make these forecasts in advance because he does not have access to some advanced knowledge that nobody else has. Now, for those familiar with the Austrian School of Economics, that is a deeply Austrian position to take. The whole Austrian insight is that no central planner, no matter how smart, no matter how many PhDs they might have, nobody can truly possess the knowledge required to manage an entire economy from the top down. The economy is just too complex. It's billions of individual decisions happening every single day. And here's the head of the Federal Reserve openly conceding that point now. I think that's big. All right, the third move, it might be the most telling of all. Warsh announced the formation of 5 task forces to re-examine how the Fed operates. So one task force will look at the Fed's communications. One will look at its balance sheet. One will look at the data the Fed relies on. One will look at the productivity, jobs, and the impact of artificial intelligence. And then the fifth one, the last one, will examine the Fed's entire inflation framework. And Warsh described this examination as the drivers of inflation, first principles, and the full range of ideas for delivering price stability. I think I got that right. But it's interesting words that he's using here. And the fact that he's mentioning first principles kind of jumps out at me. Right? So here we have a new Fed chairman in his first few weeks on the job. And he's announcing that he intends to reconsider nearly everything about how the institution operates. All of this is important. But as a financial analyst, I'm especially interested in the data piece. I can tell you firsthand that many investment analysts use data from the Federal Reserve in their own analysis. Lots of people are forming opinions and investment ideas based on this data. But here's the thing. Many of the Fed's data points just come from surveys. They're just surveys of real industries, which, it's real industries, so we have to be fair about that. But they're just surveys. Guys, how accurate do we really expect any given survey to be as it pertains to a representation of the entire U.S. economy? And we already know that it's very common for this data to be revised. The market fixates on things like the jobs data. Every time it comes out, the market fixates on the jobs data. And then a big fuss is made about it. But the jobs number, it's often quietly revised later. But the financial media just glosses over it when that happens. The revision does not get much attention. So I look at this and I have to think, what we've had is clearly a system that could be gamed. I'm not saying that it has been because I don't know, but it's a system that's structurally susceptible to being gamed. So then I have to ask, what if all these key economic data points that the market has held up as important, what if they've been mostly wrong? Right? Or what if they haven't given us a clear picture of what was actually happening in the economy? So I'm very interested to see what comes of this. And I do hope that they legitimately assess the Fed's data in good faith. It's one thing to form a task force and say you're going to do something. And it's something entirely different to actually do useful work. So we'll see. But based on what I've seen so far, Warsh looks like he means to shake things up. So I had to ask, who is this guy? And I was pleasantly surprised by his background. Now, back when the Phoenician League launched in 2022, we spent a lot of time on a particular hypothesis. And it was the idea that the Federal Reserve and the New York banking faction had broken ranks with the globalist institutional order. And a big piece of that analysis was Jerome Powell. He was Fed chairman at that time. Powell was not a career academic the way most Fed chairmen before him had been. He came from Wall Street. They called him Private Equity Powell on the street. Well, it's the same story with Kevin Warsh. Warsh served on the Fed's Board of Governors from 2006 to 2011. So he was there in the room during the 2008 financial crisis, while the whole system was burning down. And having been essentially powerless to stop the shenanigans coming out of the Fed in the wake of that crisis, Warsh resigned. He walked away. And for the next 15 years, he sat at the Hoover Institution at Stanford, which is a kind of a bastion of supply side and classical economic school thinking, which for the most part rejects the activist interventionist central planning model that's dominated our institutions for really decades now. But that's not all he did. During those same 15 years, Warsh worked for Stanley Druckenmiller at Druckenmiller's Duquesne family office. I can tell you from being in the investment space, Druck knows what he's doing. And in a recent interview, Warsh was plainly proud of working for him. He called Druckenmiller the greatest investor in the history of the world. And you know what? There is some merit to that. Druckenmiller's hedge fund averaged 30% returns for nearly 30 consecutive years. And he never had a single down year. Not one. Guys, that is really hard to do. Just for context, $10,000 invested with Druckenmiller's fund in 1981 would have grown to tens of millions of dollars by 2010. And here's the thing about Druck. He's a macro investor. He analyzes big picture macroeconomic trends from a top-down, data-driven perspective. And I'm nowhere near his pedigree, but that's largely the same way that I approach our equity portfolio at the Phoenician League. And there's one more connection here that I think is very telling. So back in 1992, Druckenmiller was the lead portfolio manager for George Soros's Quantum Fund. He was there when they made that massive bet against the British pound, and they famously broke the Bank of England. For those who might not be familiar with it, that's still today one of the most legendary trades in financial history. Well, the man running Quantum Fund's London office at that time was Scott Bessent, the current Treasury Secretary that we talked about last week. He was right there too. He was integral to pulling off that trade alongside Druckenmiller. So follow the web with me here for a minute. Here we have Bessent, who worked with Druckenmiller at George Soros' firm. And of course, Soros is somewhere very high up on the globalist hierarchy. He's funded all kinds of corrupt DAs, politicians, and all kinds of other wacky stuff to undermine American society. So I have to assume that these guys understand the globalist mindset, at least to a degree. But as we discussed last week, Bessent made it clear that the U.S. is rejecting globalism. And Druck has spent the last decade sounding the alarm. He's been warning that quantitative easing and runaway deficit spending are corroding the very foundations of the American economy. And he's argued that years of ultra-loose money, of zero interest rates, and massive asset purchases by the Fed has created dangerous bubbles and distorted really the entire economy. He even called it the biggest redistribution of wealth from the middle class and the poor to the rich. He said it was the biggest redistribution in history. So these guys, Bessent and Druckenmiller, they understand the globalist push, but both of them appear to wholeheartedly reject it. And now we find out that Warsh is in the same orbit. Okay, that means the new Fed chairman and the current Treasury Secretary, they share the same intellectual bloodline. They both understand the plumbing of the global central bank dominated financial system probably better than most people alive. And they appear intent on major reforms. So Warsh came right out and said the quiet part out loud. He said outright that inflation is a choice. It's just a choice. That's after 50 plus years of Keynesians telling us that inflation was kind of this mysterious force that needs to be controlled and manipulated. Warsh said no. Inflation's just the direct result of bad policy decisions. And I believe that's unequivocally true. Right? And Warsh said so to the world. That's another very Austrian-like position to have. Now, guys, I'm just acting as an objective analyst here. I'm assessing the situation from afar without injecting any of my own opinions or my own biases. And I found that doing so helps me to see the breadcrumbs and kind of connect the dots better than I otherwise could. So I don't have any inside information, but in following the breadcrumbs, I should say, following the breadcrumbs and trying to connect the dots, I'm starting to see a picture forming here. So it looks to me like Jerome Powell quietly, almost stealthily, broke the Fed's connection to the global central banking cartel and reasserted America's sovereign control over its own monetary system. He may not have had a grand theory for why he was doing it. I don't know. But whatever his motives, Powell did clearly sever the Fed's ties to the global central banking cartel. So far, it looks like Warsh represents the next chapter of that same story, except it's a more overt, more aggressive chapter this time. And it does look like Warsh has a clear purpose driving his moves. As I noted before earlier, he's talked about first principles several times now. All right, so what does this actually mean? I'll start with the single most important thing Warsh could do, and the one that gets probably the least attention, and it has to do with the Fed's balance sheet. So before the 2008 crisis, the Fed held about $800 billion in assets on its balance sheet, and that was almost entirely U.S. Treasury securities. Today, the Fed's balance sheet sits at around $6.8 trillion. So that's roughly 23% of the U.S. economy, and it's about 7 times its pre-crisis size. Warsh has called that balance sheet bloated in print, and he said plainly that it could be shrunk while still allowing interest rates to come down. Now, here's why that's such a big deal. When the Fed holds trillions of dollars in Treasury bonds, it's acting as a permanent, reliable buyer of government debt. That buyer keeps yields lower, interest rates lower than they otherwise would be, and it quietly subsidizes the federal government's borrowing in the process of doing so. So that makes it cheap and easier for Washington to run these enormous deficits that they've been running. So if Warsh shrinks that balance sheet, that subsidy starts to fade, right? At least to an extent. If that happens, the Fed stops being the enabler of unlimited federal spending, right? And if we ever want to have a robust economy again, we do need to put an end to all the fraud, the waste, and the abuse that's embedded in the U.S. government's annual budget. But here's the thing. President Trump has been adamant about wanting lower interest rates. And that's not going to happen right away if Warsh starts making major reforms. So how does it all play out? I don't know, but I'm very interested to see. All right, so let's talk about what this means for those of us trying to make good decisions with regards to personal finance and investing. While I find economics and economic history to be fascinating, at the end of the day, I'm an investment analyst, and I've found that if you can identify shifting macro trends early, you can make some very lucrative investments. So to that end, I remain confident in our core strategy here at the Phoenician. And that starts with gold and Bitcoin. We use those as a foundation. I know both have pulled back in price recently, but to me, that's just noise. I don't view either as an investment in the conventional sense, and I think we talked about that last week. I view gold and Bitcoin as savings. When I buy gold and Bitcoin, which I do every week, by the way, I'm not trying to buy low and sell high so that I have more dollars later. That's not what I'm doing. Now, I'm converting my dollars into hard money. That's how I see it. I also believe very strongly in the principle of building monthly cash flow, which Retirement Incorporated has cleverly distracted people from. But think about what happens when you suddenly have, $1,000, $2,000, maybe $3,000 a month in extra income coming to you every single month, right? Just hitting your bank account. Maybe that's not entirely life-changing, but wouldn't it be a lot easier to get ahead if you had thousands of dollars coming to you in extra income every month? Now, what would happen if you built a tax strategy around that income and actually reduced your tax bill, which might mean getting much larger tax refunds each year, right? And then let's suppose you take those tax refunds and you make more investments with them. You work up to having $10,000 a month or more in extra cash flow. That starts to change things, right? And that's why I very much like investments in things like real estate, mortgage notes, royalties, and other alternative assets. Things that Retirement Incorporated does not want us to talk about. And then there's our stock investments. And this is where seeing the macro shifts early can really be magical, which is how Druff's hedge fund was so successful for such a long period of time. Well, if we connect the dots, and if we can confidently say that Keynesian economics is being rejected, And then if we can track the breadcrumbs and see that the administration is trying to reinstitute Hamilton's American system, or at least some modern version of it, suddenly it's very clear that industrial policy is going to favor domestic manufacturing, commodities, rare earths, conventional energy like oil and natural gas and uranium for nuclear power. Right? We are heavily concentrated in those areas at the Phoenician League with our core equity portfolio. And if we take that one step further and recognize that these things will increase industrial economic activity in America, well, then we can quickly intuit that, well, all this activity is going to need insurance, right? And it's going to need lots of it. So if we know how to analyze property and casualty insurance companies, we can identify several of the best ones in different areas of the insurance market, which is also what we've done at the Phoenician League. And then if we understand the insurance business model and how they manage what's called the float, well, we'll quickly realize that these companies essentially print money in an era where interest rates are normalized and bonds actually pay a real rate of return again. So I think property and casualty insurance should be the cornerstone of a robust equity portfolio right now. And then from there, we can sprinkle in, some stocks that maybe represent trophy assets and iconic world-class American businesses, maybe some tech, some up and coming tech plays in there too. And we'll have a stout portfolio that's going to outperform the market. But remember, your investment strategy should be comprehensive. Okay. Each piece should work together. And I firmly believe that. And we should always remember that investing is about ownership. All right. Investing is about ownership. The things that we invest in should be things that we want to own, right? If we don't want to own something, we shouldn't invest in it. And I'll leave you with one more for today. And this is a little zinger that I got from Porter Stansberry, and it's always stuck in my head. He used to say, opportunity is infinite, but capital is finite. And the implication there is that we never need to chase anything in the investment world. Just be cool and let the game come to you. And by the way, if you would like a deeper rundown on our investment strategy, we will host our next Phoenician League public-facing strategy session on July 2nd at 7 p.m. Eastern. Just get on our email list at PhoenicianLeague.com for more information on that. And I'd like to leave you with just one final thought for today. The financial press, guys, the financial press is watching the wrong things. Okay. They're watching the federal funds rate and they're wondering, well, is Warsh going to cut rates or is he going to raise rates? And then they're watching what's almost certainly faulty economic data. And they are assuming that policy decisions will be made based on that data because for the past several decades, they always have. Friends, I'm confident in saying the game's changed. The financial media will be slow to recognize that and even slower to report it. But if you have eyes to see, and if you're still with me at this point, I'm sure you do, then I think there are some great investment moves that we can make before the crowd kind of wakes up to what's actually happening. So come to our strategy session at the end of the month if you'd like to get into that idea more deeply. All right? So that's all from me for this week. I'll see you next time. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at PhoenicianLeague.com. We often send out detailed written analysis on the various investment opportunities in the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at PhoenicianLeague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.